Happy holidays from the Keen Wealth Planning team.
Merry Christmas and Happy Hanukkah from our family to yours.
Happy holidays from the Keen Wealth Planning Services team.
Merry Christmas!
Merry Christmas!
Happy holidays from the Eshelman family.
Happy holidays from the Flynn family.
Happy holidays from the Keen Wealth Marketing and Compliance team.
Merry Christmas and Happy Holidays from the Efrons.
Merry Christmas and Happy Holidays from the leadership team.
Merry Christmas and Happy Holidays from the Keen family.
As we find ourselves in the heart of yet another holiday season, the team and I at Keen Wealth Advisors want to take a moment to express our deepest gratitude. As we reflect on this special time of year and look ahead to 2025, we want to sincerely thank our clients for allowing us the privilege of serving as your financial advisor. We never take for granted the unique position we hold in being part of your lives, and in many cases, serving multiple generations of your families. We approach this responsibility with great seriousness as we guide you through complex financial decisions and personal milestones. There's nothing more fulfilling for us than seeing our clients, each at different stages of life, being wise stewards of their resources while living out their best lives with confidence and intention. As this year comes to a close, I also want to recognize and thank the exceptionally talented team at Keen Wealth Advisors. Their dedication to your success is unwavering, and I could not be more proud of the culture that we've built together. The character, professionalism, and commitment that they demonstrate to our clients, our community, and to each other make all the difference. Many of you joined us at our recent holiday celebration at our beautiful headquarters here in Lighton Tower. We enjoyed delicious food, a live harvest, and various family-friendly activities like cookie decorating, reindeer games, and numerous holiday crafts. Santa himself made an appearance again this year, and we had our Keen Wealth in-house photo shop up and running, capturing the moment for all. Rest assured, we will host this event again in December of 2025 and look forward to seeing you and your families there. We are also excited to announce that our family-friendly summer barbecue event will return in May, so be on the lookout in the coming months for the date and details and mark your calendars accordingly. We'll have plenty of fun activities for the kids, so bring your family as well as friends and colleagues who might enjoy being a part of the Keen Wealth community. These events provide a unique opportunity for fellowship and connection that truly sets us apart from other financial advisory firms. And finally, I am proud to share that our team made a significant impact in the local community this past year. The Keen Wealth Foundation, led by my wife, Carissa, provided substantial financial grants to various charitable organizations. And our Keen Wealth Community Impact Committee, along with the entire team at Keen, served over 1,000 hours on site at organizations such as Happy Bottoms, Veterans Community Project, Angel Flight Central, Kansas City Girls Preparatory Academy, Health Outreach Foundation, and multiple other wonderful charitable organizations. I could not be more proud of the Keen Wealth team's dedication to making a difference in the lives of local families and our community, and look forward to continuing the spirit of generosity for many years to come. And now for our next speaker, Matt Wilson, President and CIO of Keen Wealth Advisors. I've had the privilege of working alongside Matt for nearly 23 years, as his experience through multiple market cycles, along with his data-driven insights, are central to our work. Today, Matt will share his 2025 outlook, which I am sure you will find insightful and informative. On behalf of myself and my wife, Carissa, and the entire team at Keen Wealth Advisors, we wish you a joyous and blessed holiday season and a happy, healthy, and prosperous 2025. Matt, the floor is yours, sir.
Well, thank you, Bill. I appreciate putting together these webinars throughout the year and always look forward to hosting this year-end one, just to recap everything that we've been through in 2024 and, of course, our outlook for 2025. Definitely a lot of things to talk about. We've got a new administration coming in, or a different administration. I guess some of them have been in the in those offices previously, so maybe a little bit of familiarity, but definitely some changes that'll be coming through. We'll talk about that. But yeah, I appreciate everyone joining us, and any feedback that people have, always appreciative of that. From time to time, I do hear certain things that would help make the presentation better, and take that into account for sure. So if any questions, comments, feedback, please feel free to shoot them over to me, or send email, reply to any of the emails that you receive from us, and we will get that taken into consideration. Well, what I want to start speaking about is where we are in the financial markets. We've had a good year, 2024, a very good year by many standards, and that's on the heels of a very good 2023. And this isn't surprising. Good years, they do happen. There's data out there to say, well, how many times does the market produce over 20% returns? And I believe the number is over, it's around 30% of the time. So 3 out of every 10 years, you're going to see a very good return. Then we've got periods of time, and it's about 75% of the time market's higher, which means 25% of the time markets are lower on a 1-year basis. And so, that's 3 out of every 10, 2.5 out of every 10 years, we're going to have a negative return. And we account for that in our financial planning and everything else that we utilize here at Keen to make sure that we're having all the clients in the correct allocations, taking into consideration distributions and everything else that is part of what we do. But what we want to speak about is where we are today. The S&P 500, that's a index, represents 500 of the technically largest companies here in the United States. The purple is the Russell 2000. So that is considered small cap companies, so smaller businesses, less than 10 billion in market capitalization. I've got real estate, and primarily commercial real estate, represented here in the green, lighter green, and then darker green is emerging markets. So these are countries, so international businesses, international countries, businesses that are headquartered in overseas in areas that are emerging. They're not quite yet developed, based on the definition. So we've got those. Then we've got developed international stocks, and then lastly, this is commodities. So a basket of commodities. You kind of see how those different asset classes have performed for the year. And again, I like to point this out on each of these market update webinars, just to show where we're at and how the different asset classes do different things. One of the kind of notable pieces here is, we've had a strong year in the large companies, but small companies they've been a little bit more volatile, which is normal. But you see these spikes from time to time, and there's definitely one kind of post election or right around the election in these small company stocks. And I think a lot of that's reflected of the administration that's coming in, and some potential deregulation, which would generally help those businesses more than others. This is a breakdown then of the different sectors within the stock market. So these look at different areas that companies are focused on. So very top here we have communications, and a lot of that's represented by kind of social media companies, Facebook or Meta. Consumer discretionary, so these are things that you purchase with discretionary funds. Typically see those perform well in strong economic cycles, growth cycles. You have financial stocks, technology stocks, utilities. Utilities have had a very good year. Industrial companies, consumer staples. These are companies that sell goods and services that you're going to purchase no matter what. You'd see your grocery store businesses, things like that represented here. Real estate, energy, materials, and then healthcare is the laggard this year. All positive, but ranked from best performer to lowest performer. Now moving over to fixed income. So this is when you loan money to a business or government. This actually is representation of the U.S. Treasury yields. And you can see the yields have been up and down this year, started the year creeping higher, and then we've trended lower up until end of September, and then have been creeping back up. 10-year Treasury at 4.4%, 5-year Treasury at 4.2%, and then you've got the 2-year Treasury at 4.2%. So not a significant difference between all three of those, which has been the norm for for many years. We are seeing a little bit of a uninversion of the yield curve, which I have a chart on that here that I'll show you in a few slides. So the longer term bonds are yielding more than the shorter term bonds, while earlier in this year we had the shorter term bonds paying more interest than the longer term bonds. Now, what does that mean from a performance standpoint? So you earn the coupon or the yield while you own the bond, but the bond will fluctuate in value, just representing if you wanted to liquidate that bond prior to maturity, what would you receive? And this chart has all these different colors represent different maturities. So the red line, that's just kind of straight higher, kind of ticking higher, that represents short-term U.S. Treasuries. Essentially, I would say it's very similar to money market, kind of what you would be receiving in a money market fund. And so that's normal to see this this basket to not have a lot of volatility because it's so short-term in nature. When yields are low, yes, this line is close to zero if yields are low, but it doesn't, again, fluctuate a lot. And then as the length of time until you receive your funds, so meaning the maturity of the bond becomes longer and longer, well, then you introduce what we call interest rate risk. And so that is when interest rates change, that risk is what changes the value of the bond should you want to sell it in the open market. And it's essentially kind of reflecting a opportunity cost, because let's just say 5 years ago you purchased 10-year bonds when interest rates were near zero and you might have only received like 1.5% a year for 10 years. Well, right now those bonds aren't worth a whole lot. They're still worth something, but they're worth a lot less than when you purchase them if you wanted to sell them, because you can get, as I just showed, 4.4% on a 10-year bond. So no one wants your 1.5% 10-year bond. So that's what that reflection, in terms of these performance numbers is reflecting. If you hold it to maturity, you get your principal back, assuming the government doesn't default, which it's never has, considered risk-free for the most part. You just had that opportunity cost of what you could have earned if you owned a higher yielding bond. This darker blue, that's 1 to 3 years. Then you've got the green, 3 to 7 years, purple, 7 to 10 years, light blue, 10 to 20 years, and then this orange, 20 plus years. And those haven't done that great this year. And it's a reflection of interest rates kind of moving around. So in the beginning of the year, when interest rates went higher, your existing bonds went down in value and the longer term ones went down more in value. And then when interest rates in the middle of the summer, all the way in towards the end of September, as I kind of showed in the previous chart, came down, well, then the performance of those went back up. You can see it's very volatile. So long-term bonds are very volatile. We focus primarily on short-term bonds with our clients, especially clients that are retired, because we want the stability. We don't want the volatility with that's comes along with long-term bonds. Now I want to touch a little bit on diversification. You know, some of the questions that I've received throughout the year was a little bit more on these presentations and how when I show all these different asset classes, like, well, what does that mean to them? Because when we put together portfolios for our clients, we have diversified portfolios. So we have different asset classes, which, you know, that it could be all stocks, you know, in those asset classes, especially if someone's younger, but there's still different types of stocks. You know, I showed the sectors, different sectors, but there's also different capitalizations, you know, very, very large companies, and then you have small companies, and they all perform slightly different based on market dynamics and other things that are happening. But then you have bonds, you know, which we're utilized for clients that are retired and pulling out distributions, you know, certain purposes too. If someone is just saving for a short-term expense, well, then we typically use bonds or fixed income because we don't want to introduce a lot of volatility in those situations. What this graph, this chart represents is going back to 2009, different asset classes. And what's presented here is each column, it's the best performing asset class that year, all the way ranked all the way down to the worst performing asset class. So in 2009, emerging markets equity up 79%. Now, it doesn't have 2008 on here, which would show emerging markets performed very bad. So this is a kind of a snapback performance, but 79%, whereas cash or money market earned 0.1%. Now 2010, what you'll notice is, yeah, there might be some trends short term where you might see a box or an asset class perform well over certain periods of time, but what we always ask people, especially when we're talking about this in person or during some of our presentations, live presentations, is that if I were to cover up some of these future years, I ask people to guess what they think the best performing asset class is in the future. And yeah, some people might guess it correctly, but there's no predictive ability based on history as to what will perform best in the future, especially on a 1-year basis. You know, when we can move out longer, we've got 10, 20, 30, 50 years of data. Yes, we can see trends over long periods of time where things kind of revert to means. But on a year-to-year basis, it's impossible. And I kind of point out here, this is, I circled small cap. It's easier to see the orange boxes here, but you can see how they're just, it's all, some years really good, some years kind of lower in the pack, and how it all kind of plays out. Interesting to watch. Now, what I want to show next related to this chart is there's a white box that had a line in it, and it's just called asset allocation. And it represents a diversified portfolio. And this is the weightings of those asset classes that represent that white box. So you can see 25% in large companies, 10% in small companies, 5% in emerging markets, 15% in developed markets, 5% in commodities, 5% in high yield bonds, 25% in kind of our core bonds, 5% in real estate investment trusts, so those kind of commercial real estate properties that are publicly traded, and then 5% in cash. So the breakdown, if you were to add this all together, is about 65% stocks, 60% stocks, 5% commodities, and then 5% in bonds and short-term fixed income and cash, which is, a diversified portfolio. What this does is each year you own those weightings and then you rebalance it at the end of each year. So in 2009, emerging market equities they were up 79%. Well, you'd be selling the profit, because we only have a 5% allocation to emerging markets. So if that happened to grow, let's say the 5% grew by nearly 80%, that would be maybe close to 8.5%, 9% by the end of the year. Well, we want to bring it back down to 5%. So we rebalance, we sell the profit, or at least the over and above the allocation, and bring it back. That's what rebalancing does. So it keeps, it takes profit out of the things that are doing well and puts it in the things that have performed poorly, because that will harness the volatility. So in 2008, as I mentioned, it's not on here, emerging markets didn't perform well. You would have been buying emerging markets just in time for it to be up 80% or almost 80% 2009. So it's, instead of being kind of whipsawed by trying to figure out what's going to happen going forward, we know over long-term trends what performs best over long term. We have weightings based on that, and then we rebalance it to bring it back. And what this does is it ensures that, yes, you're never the best performer, because it's a mix of all these components. So you can't be the best performer, but you're also never the worst performer. Comes in the middle. And you can see we're an asset allocated portfolio through end of last week, based on those percentages, is the third best performer for 2024. So I wanted to touch on that, just diversified portfolio, just, that I think encompasses more of a reflection of what we're doing here. So, because it does, it when you look at it like that, the case for owning large companies, small companies, owning bonds, owning emerging markets, owning non-US positions, you can see that over those long periods of time, why those components are in there. This now is all of those asset classes that I showed earlier, the stocks and the bonds year to date, and then I have the asset allocated portfolio. So the boxes in our previous couple of slides, they don't necessarily they don't give you an idea on the volatility. It just shows you a return for the year, and that's can be, volatility can be difficult for people for sometimes. So you see the returns, but to earn those returns, you have to live through some periods of volatility, and that's not always easy for folks. So kind of to see, okay, this is how all those different components have performed throughout the year. And you can see, yes, asset allocated portfolio, third best, of all these different asset classes. So I'll continue to show this going forward in our future presentations. Now let's talk about the economic data. I have an update of the charts and graph that I normally share. So we have employment, retail sales, building permits, business spending, and the yield curve. Well, employment continues to tick forward at 159.2 million jobs here in the United States, well above pre-COVID jobs. There's still job openings, yes, less so than the previous few years, but higher than where we've been kind of pre-COVID. So still on the high side. Initial claims, this is when workers first get laid off, and then they continue to file for unemployment benefits. So what we've got here, this January 25th, 2020, 1.8 million was what the continued claims were. spiked here to 23 million in May of 2020. And then now we're still back at 1.8 million. So we're right at where we were kind of pre-COVID levels, and not a significant uptick in that number. Nothing to be concerned about. We've got retail sales. This is what consumers spend their money on. That still continues to tick higher. Building permits. So this is, new homes, and building permits have been slow. You can see if we draw a trend line here, I mean, it's probably a little slightly below trend, but it's not significantly off if we were to just go back through the 2008, 2009. But housing does go in these types of cycles, and definitely slower because of, one, the pricing, and two, interest rates are higher. Businesses are continuing to spend. That's been very steady since the recovery of COVID over the last few years. And then lastly, I've got the yield curve. So this is a representation of financial conditions. I sometimes say it's like, is money tight, or is it is it easy to get? So when interest rates are low, money is considered easy, and then when interest rates are higher, yes, tighter financial conditions. It just costs more for businesses to take out loans, and consumers, if they have debt, things cost more, like I just mentioned on housing. Well, the yield curve, when it inverts, that's when the short-term rates are higher than the long-term rates. And that happens typically when the Federal Reserve is trying to slow down the economy, trying to tighten things up, make things less easy, and they raise interest rates, which has a correlation to all the other interest rates. Like they only control one interest rate. They don't control the treasury rates. Those are controlled by supply and demand, but they're all kind of related. So when they raise rates, and maybe too quickly, then we have this inverted yield curve. And what we've seen in the past is anytime you see these gray bars on these graphs, those represent recessions. And this black line when the blue line is below the black line, yield curve is inverted. Well, what I've circled here is all the inversions have happened prior to recessions. Right there. Late 80s, right there. 99, right there. 2007. Pre-COVID, which the yield curve inversion did not predict COVID. It just was happening at the time. And then here's where we're at today. Now the yield curve is uninverted. I showed that earlier. The 10-year treasury is yielding more than the 2-year treasury. Now this is 10-year and 3 months, but it's all, very similar. And but we haven't had a recession. People have been calling for a recession for several years, but there has not been a recession. So it's just something to pay attention to. Moving on to earnings, this is a lot of folks' most favorite, I think, part of my presentations, where I provide the market multiples. And the reason I do that is because, it's important to kind of figure out, well, where do we think the markets are headed over the short term, over the next 12 months. No one has a crystal ball, but with data, we can come up with some educated projections about where we think things can be. And that helps with allocations and how we have the portfolios positioned. Well, I have earnings listed here on this graph, and the market is the price of the stock market. Like when you hear that the Dow is at 45,000, S&P's at 6,000, the NASDAQ's at 20,000. And, it's common, it's definitely reasonable for someone to think, well, why is it going higher? And that's a lot. Like, should it be that high? Should it just come back down? Because you remember this, if you've been, investing for some time, and you might remember the Dow, it was at 10,000 back in late 90s. And now it's at 45,000, and it's going to go to 100,000. I mean, that's just what happens over time. And the reason that happens is because earnings go up. That's what those values are a reflection of earnings. So right here, I've just got the last 2023. 2024 is not complete. We'll have the finalized number here in Q1, Q2 2025, estimates for 2025, and then estimates for 2026. It's almost up 50% in terms of estimates by year-end 2026 based on comparing it to year-end 2023. Well, you could look at that and say, well, that could be mean the stock market could be 50% higher because earnings doubled, or they went up 50%. So that's what stock prices are. They're just a reflection of earnings, and then there's a multiple applied to those earnings. That's how much are people willing to pay for future earnings. And some companies have very little earnings or no earnings at all, and their multiples are infinite if they have no earnings. And that means, and if their stock prices are performing and their values going up, it's like, well, people are willing to pay a lot because they're betting on the future earnings that they believe those companies will make. So the market's always focused on earnings, and earnings are performing well. I mean, companies are generating more revenue and they're generating more profits. So let's look at the multiples. So as we progress through 2025, the market will begin to look at 2026 earnings estimates. And this is estimates based on all the different analysts that are out there that are providing earnings reports and research to investors. And they compile all that and they come up with these estimates. And the reason is because as we go through 2025, the market wants, it's discounting future earnings. So it wants to know, okay, well, if 2026 estimates are $310, then we think, prices at the end of 2025 should be this based on earnings estimates and based on multiples. If there's a lot of uncertainty about these estimates, i.e. economic data looks bad, maybe there's not an official recession that's been called yet, but could easily see a recession on the horizon, and then earnings estimates start to drop, well, then stock prices drop because it's a reflection of that. So when certainty's high, multiples tend to come down because people aren't willing to pay more for those future earnings because they're not sure about those future earnings. When there's always uncertainty, so there's never certainty, but when there's less uncertainty, people are willing to pay more for those future earnings, meaning multiples will go up. So we've got, this was as of December 16th, a couple of days ago. The S&P 500 closed at 6,074. And if we just apply the multiples that I've been using for many years, gives us a range of year-end values for the S&P 500. So if multiples come down, like right now, if we were to actually do it right now, if we take 6,074, divide it into current earnings, like right now, the 2024 estimates are $239 a share. So take 6,074 divided by 239. The current multiple is actually like over 25. And I don't show 25 on here, partly because I don't think 25 is sustainable long term, but that doesn't, market doesn't care what I think. It could definitely stay at 25 throughout 2024, meaning my estimates could be on the low side. But let's just say if uncertainty started to pick up, people weren't willing to pay as high a multiples came down. Well, that could be 55.80 on the S&P 500. A 20x multiple, 6,200, 22 multiple, 6,820. So if we look at that and say, okay, by year end 2025, based on these multiples, we could see the S&P down 8% to up positive 12.2% over the next 12 months based on S&P 500 6,074. And again, if multiples are higher, then this number will be higher by year end 2025. So just, I think it's important to have those projections based on what we're seeing. And then, of course, I update these every single quarter when we talk about it, because economic data is always changing. Earnings are being updated as we go throughout the year. As we go throughout 2025, 2027 earnings are now starting to play a factor into what those multiples look like. Interest rates. When I put this slide together, interest rates were slightly higher. They met on Wednesday and lowered interest rates just a tiny bit and said that they may not lower them as much in 2025. Again, they're always data dependent, so it's just based on what's going on. But I think what the Fed's concerned about is just inflation is slowing, but it's definitely not, prices aren't coming down. They're just not growing nearly as fast as they were, but probably still a little higher than where they'd like. So they'd like to keep interest rates higher to continue to potentially slow down the economy. Not, they don't want to crash it. They just want it to slow so inflation slows down. But by year end 2025, 3.5% to 4.25% is kind of what the market's projecting. So not, maybe 2 to 3 rate cuts in 2025. And here's inflation, all the different components of what I've got here is what's called CPI, or the Consumer Price Index, and this is headline CPI, which includes food and energy. There are other metrics that don't, but this does include food and energy. You kind of see where things were at the kind of peak post-COVID, and then they have been trending lower. The last few months been in the 2.5 to 2.7 range, and slightly higher over this last month, but it's still trending in the right direction, which is the key to this graph. So let's move on to our 2025 outlook. So of course I shared with you our market multiple, but I put it in the context of around kind of certainty, uncertainty, and that's always existed. So I do get questions about, well, what are the risks? Sometimes I talk about a lot of the positives, and I think, well, what I like to talk about is a lot of the same economic data. So it's just, here's what the data is, and it just so happens to be trending in the right direction. But not all of it's perfect. Building permits are slow. The yield curve is a concern. It's not, the end all be all. I mean, the most important things, I think, are how healthy is the consumer, because consumption is what drives our economy. If people have jobs, they spend money. If they don't have jobs, it's a lot harder to spend money when you don't have income coming in. And when money's being spent, that shows up as revenue to corporations, which turns into earnings, which then is what stock prices are a reflection of. So if people are spending money, great, that's good for earnings. If they aren't spending money, well, then that's bad for earnings. So it's a simplistic way of looking at it, but that's kind of how our system works here in the United States. But these are risks. This was a survey that Deutsche Bank put out, and they asked, which, if any of the following, do you think pose the biggest risk to market stability in 2025? And they asked people to select up to 3. And and this is probably hard to see for all of you on the screen, just all the different, but my point being, there's a lot of risks listed here, but there's always something to worry about. This has never not been the case. Yeah, sometimes they change, but a lot of times they're just kind of reworded and in a different order. Very similar in terms of what the actual risks are. I mean, a global trade war, yeah, you could have that on. That wasn't necessarily on people's radar last year. Definitely is this year, based on the President-elect Trump talking about tariffs. I mean, people are concerned, and this actually, funny enough, that can be the catalyst either to to maybe abandon tariffs or not, is based on how the stock market's performing. Because if it's looking like those tariffs could be a big threat and a big hurdle to consumers here, meaning prices are going to go up based on what those tariffs are, and stock market doesn't like it, well, that can help with someone's decision and say, okay, maybe I shouldn't do this because that would be bad for for the economy and for the stock market. There's a lot of factors in that, but just when people are so focused on something, then you typically see them make decisions with their money, which can impact impact stock prices. But this list is interesting. Again, I like to kind of see what's out there, but there's a lot of different things that come into play. And right now, we're heading into 2025. We are on what's considered a soft landing, meaning the Fed is trying to slow down inflation without, they say soft landing. They put it in the context of a plane landing, soft landing, hard landing. Well, if you've flown, you could definitely tell the difference between a soft landing and a hard landing, and you definitely don't want a crash landing. And the fear is always that the Fed is always too far behind. They wait too long to do things, and it's too late. Like, that's a common complaint that over the many decades that the Fed has been around, the Federal Reserve. That's what I mean when I say the Fed, the Federal Reserve. And when their interest rate or their monetary policy is just too far behind. They're not ahead of it quick enough. And when they're not ahead of it, then they react too quick, too fast in too short of a time, and then they create these hard landings, essentially kind of creating a recession. That's what the fear is. And there was a lot of fear in 2022 that the Fed, same thing, same concerns, raising rates too quickly, which was a surprise. Those risks I showed on that previous chart, those are known risks. Those really aren't that problematic to the stock market because they're already priced in. It's the unknown things that create the issues. And in 2022, what was unknown was the fact that the Fed decided to raise rates instead of a quarter point at each meeting. They raised it 3/4 of a point at each meeting. So at the beginning of 2022, at the end of the year, the projection was interest rates to be at 1%. Well, the end of the year at 4%. 400% higher than where everyone thought they were going to be. And that's why the market reacted in a negative way. Market overreacted because there was not a recession. That was the fear. There's going to be a recession. Never happened because the data never supported it. But these are other risks that maybe investors are too confident. I said PE ratio is current PE ratio at 25. That's a little high. That's definitely high. I mean, doesn't mean it has to go down. In the late 90s, we've had higher PE ratios, and they persisted for several years. What we do like to see is earnings kind of catch up to that. And if PE ratios come down a little bit and earnings catch up, that's where I showed between, a 22x multiple, we could still see a 12% return in that situation. The market is pricing in Fed rate cuts. Maybe they decide to do none, or they do a lot more. Those would be surprises. How much of the new administration, what's going to happen with, especially a lot of the proposals that they've been talking about during their campaigns, that'll come into play. And then, as I've already mentioned, valuations are high. And if, there's a big drop in earnings or in uncertainty definitely picks up, then we could see volatility pick up here in stock prices. But as I was saying, the reason stocks perform better than bonds over time is because of the uncertainty. That's what it reflects, the premium that you get as an investor when you assume the risk of buying stocks. When you loan your money to the government for 10 years, you can get 4.4%. And right now, the U.S. government's never defaulted on that. So, as I mentioned, you can basically say it's risk-free, guaranteed. Well, that's guaranteed is 4.4%. Over the last 12 months, maybe you made 5% in a bond, and there's nothing wrong with that. I mean, that's definitely, there's a place for it in portfolios. There's a place for it in our financial planning. There's a place for it in a lot of areas. So not trying to say people shouldn't have those, but when you compare it to the fact that large companies here in the U.S. made 28%, small companies made nearly 20%, you're getting that because you're assuming some risk, because those earnings are not guaranteed. Corporations, they go in and out of favor. I mean, Tesla's performed very, very well this year, but they've had years where they have not performed well. It's been all over the place. So, that's where that uncertainty creates opportunities for investors to earn higher rates of return. And the other thing with risks too is, like, some risks are more priced in than others. Global trade war is on everyone's radar. And those companies that are going to be the most impacted by that are definitely feeling that in their stock prices, because it's like, hey, and if it doesn't materialize, well, then that could be an opportunity. But others that are definitely less on the radar, or less on, less on the mainstream, definitely are less priced in and can have bigger impacts. And it's really what's not on the list that creates the most volatility. And, perfect example of that is COVID. COVID was not a scenario that was on anyone's radar in 2020. It never happened before. The government had never shut down, the US government, the economy. That's why we saw those spikes in unemployment claims and everything else. And the government paid people to stay home. They transferred money from the government to individuals' bank accounts. I mean, that's basically what they were doing. And they've never really done that. Most of the time, when the government is stimulating the economy, it's doing it via fiscal and monetary policy. So fiscal policy is what the people in Congress and the president, when they decide to raise or lower taxes, well, that can be stimulative when they're lowering taxes. Well, that doesn't necessarily put money in your pocket. It provides more spendable or disposable income to a business or to a person, individual or household, via lower taxes that they're paying. When monetary policy, that's what the Federal Reserve does with interest rates. If they have low interest rates, that means the cost of loans is low and money is easy to access, and it allows you to spend more and invest at a lower cost than when interest rates are higher. Well, in COVID, the government said, you know what, that's not going to be enough. We need to act even quicker. They started sending out all those child tax credits, and they were extending unemployment and those other things that was putting money in people's pockets in a lot more inflationary way than those other tools do. And that's why we saw that huge spike in inflation. Once those programs slowed down, now inflation's come down back to the more normal levels. So, again, that's a recent example of a risk that was not priced in. And markets dropped nearly 40% in a very short period. It was basically March of 2020, I think, bottomed at the end of April. And then by the end of the year, markets were higher. So very quick recovery too. But volatility is normal too. So when I talk about, okay, maybe uncertainty picks up, well, that's when volatility picks up. But that doesn't mean we're going to have a bad year. I've shown this a lot, but I like to always remind people of it. This is intra-year. So what this is showing is the bar, and the number at the top of the bar is the year-end return. So in 1980, the market was up. This is the S&P 500, was up 26%. But at one point during the year, it was down 17. That was the intra-year drop. All those red numbers you can see. 1987, it was up 2%, but at one point it was up a lot higher. It dropped 34%. Here's 2008. Market was down 38, but at one point during the year it was down 49. And then this year, this was as of last Friday, December 13th, 27% on the S&P 500. And at one point during the year, it had dropped 8% from the peak. Doesn't mean it was down for the year, but 8% from the peak. So this type of volatility, anytime we see drops, so on average, 14.2% intra-year decline. That is normal. I shared my market multiples and I talked about the health of the consumer and households. And I think, here's some data on that, because that is such a key component to the future market prices, is just, are people spending money or not spending money? I mean, that's such a key piece to our economy. 70% of our GDP is based on consumption, which is what we as individuals spend money on. Business spending is a portion of it. Government spending is a portion of it. What we import, the net impact of imports and exports, is a portion of it. But 70% is what consumers, individuals, spend their money on. So I think it's important to focus on that. So what this is showing, the debt to income ratio. And it's because you will hear headlines, and there's been a lot over this past year, that US household debt has risen to, $18 trillion, the most it's ever been. It's record high on these debt levels. Well, let me tell you one thing. The number's probably always going to be a record high or continue to creep higher. It's just like the value of the Dow Jones at 45,000. It's going to go higher because the economy's gotten bigger. And that's why it's important to talk about ratios, not just absolute numbers, because that doesn't provide the whole context. So what the headlines should say is that household debt is up, but Americans are in a better spot to pay for it, because the debt to income ratio has been trending lower. That's what this red line represents. So yes, total debt's high, but the ratio. So people have more ability to actually pay it off than they have in previous times. So you've got to take these things in context, not just listen to the headlines. And also, the households have a long way to go before they max out their credit cards. So what this is, these are all from the New York Fed too. This previous slide and this slide. So you've got the balances here at the bottom. This dark red is home equity lines of credit. What's the balance? The dark blue, credit card balance. And then the light red is the limit. So your HELOC, well, what's the limit? So they're not maxed out. Okay, and credit card balance, there it is. But what's the limit? Well, the limit's at an all-time high too. So they're not even close to maxing things out. So, that's again where it feels like when you hear a number like 18 trillion in debt, record debt, all that stuff. And then you're hearing stuff like this that say delinquencies have been rising, which is true. But what you really could say is that they're normalizing. They're still below where they were pre-COVID. Look at that. I mean, yeah, they dropped off during COVID and some of those transfer payments. I mean, that definitely helped. A lot of that stuff was suspended, but they're lower levels. And then go back to 03, 04, 05. Look at that. Still below those levels. Yeah, the trend, we do pay attention to that. We do want to make sure that these trends aren't getting out of hand. But that's why, again, it's important to focus on the job markets too, because when people have jobs, they're less likely to be delinquent. You start to see layoffs pick up, then you start to see, these knock-on after effects, and that is delinquencies pick up and everything else. The other thing I think is important to note is that wage growth has outpaced inflation for the last 18 months. So this dark green is wage growth, and then inflation here in the light tan color, light brown. We'll go back to early 2023, and wage growth has outpaced inflation. So most Americans will be able to get ahead because of that. So even though prices aren't going to come down, we're not going to see, deflation. That's not something that the Federal Reserve wants, and it's not really good for the economy when prices are starting to drop, because then people hold off spending money wanting to get a lower price, which then just kind of perpetuates the cycle. You don't want that. When you just like this steady small increase in prices, and that that is a good, healthy economy, because it encourages people too. If we never had inflation, well, then whoever had the wealth whenever it was created a long time ago, they'd still have it today. Inflation, what that does is it incentivizes people to then not just sit on assets in cash and do nothing with it. It incentivizes people to actually do something with it, invest it for higher rates of return that will outpace inflation, such as investing in businesses and loaning money out. I mean, that's then what cycles through the economy and allows other people to participate. So inflation in and of itself is not a bad thing. It's just high rates of inflation we like to avoid. So again, reiterate, year-end 2025. I could see us in a range. It could be down. Again, we'd have to see things change to the worse based on current data. This does not look likely. But again, as data changes, I will update everyone, let them know where they're at. But there's not signs of the multiple needing to go down to 18, especially from where it's at 25. If it even drops down to 22 from where we're at today, we could see over a 12% return on the S&P 500, which is going to be a reflection of a lot of the stocks in people's portfolios will participate in some form of fashion in that level of return over the next 12 months. Well, again, thank you all for joining us today. Appreciate each and every one of you. I know my voice is a little scratchy, so hope it wasn't too distracting. But again, thank you all for joining. Have a Merry Christmas, Happy Holidays, Happy Hanukkah, and a good and prosperous 2025. Feel free, we've been posting these webinars. We've been actually putting our podcast on YouTube now as well. Feel free to share those with folks. You can check out everything at keenwealthadvisors.com under the Retirement Resources tab. Former replays, podcast episodes, blog posts. If you'd like a copy of Mr. Keen's Amazon best-selling book, makes a great stocking stuffer too. Send me an email, mwilson@keenwealthadvisors.com, and I'll make sure that we get a copy sent over to you. And then, yes, as I mentioned, our YouTube channel is up and running, so check that out, youtube.com/@Keen Wealth Advisors. All right. Thank you.